You look what happened in 2008 and 2020. Gold and silver went down, the stocks related to them tanked, but they were V bottoms. In other words, they fell very quickly and then they bounced very quickly off of that and went on to new highs. I think the worst case scenario, gold, silver, and the gold and silver miners, is another repeat of that where they do get hit hard for a little while. That equities bear market and that recession causes governments to panic and come in and just flood the system with newly created currency and to push interest rates down back down to zero again. That causes the gold and silver miners, along with gold and silver, to just spike off that V bottom and then have a really nice run.
As the co-founder of the widespread financial website dollarcollapse.com, John Rubino has firmly established himself as a leading voice in the investment community. Known for his insightful analysis of macroeconomic developments and their implications for investors, Rubino has become a trusted guide in navigating the increasingly volatile economic landscape. One area where Rubino's expertise has proven particularly valuable is the behavior of precious metals during periods of economic turmoil. He observes, recessions can be tricky for gold and silver stocks, as the overall stock market downturn tends to pull them down as well, as happened in 2008 and 2020. However, Rubino's analysis suggests that the declines in gold, silver, and related mining stocks during recessions have often followed a V-shaped pattern, sharp drops followed by quick recoveries to new highs. This phenomenon, he explains, is primarily due to the response of governments and central banks, who typically resort to flooding the system with new currency and lowering interest rates to stimulate the economy. Historically, such aggressive monetary policies have benefited precious metals, as investors seek out these assets to hedge against the erosion of fiat currencies and the threat of inflation. During the 2001 recession, for example, while global stocks were declining at unprecedented rates, gold gained about 7.3%, while silver fluctuated around $3 per ounce, showcasing its resilience in the face of economic turmoil. The global pandemic outbreak saw substantial economic disruption, with much of the world entering some of the worst recessions in peacetime. After initially falling in price, silver rebounded on huge investor demand and industrial demand as industries reopened. Please tune in for our exploration of John Rubino's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
You definitely want the non-gold bug population to get interested in gold stocks at the peak of the cycle. That's when it happens. The last couple of years of a gold silver bull market usually has a lot of outside money coming in, and there are people who don't necessarily understand the concept of mining very well, but they see something moving. It comes up on their momentum screens, and they want to jump aboard that momentum. And you get a lot of people doing that towards the end. I think we will again. The recession coming thing is pretty tricky because normally what happens in a recession is the economy slows down, people get very worried, stocks tank, and that pulls down even the gold and silver stocks. And that happened in 2008 when gold and silver themselves and the mining stocks related to them just went straight down. And it happened in 2020 when the pandemic hit and everybody was scared. Stocks tanked, gold and silver tanked, and the gold and silver mining stocks all tanked. And so since we've got that coming, that's the kind of thing that should make you a little bit more cautious than you would otherwise be with gold up this high with mining stocks. Because we might have that kind of a baby being thrown out with the bathwater thing in the equities markets in 2025. History is actually kind of favorable for something like that too. If you look what happened in 2008 and 2020, gold and silver went down, the stocks related to them tanked, but they were V bottoms. In other words, they fell very quickly and then they bounced very quickly off of that and went on to new highs. So I think the worst case scenario for gold, silver, and the gold and silver miners is another repeat of that where they do get hit hard for a little while. That equities bear market and that recession causes governments to panic and come in and just flood the system with newly created currency and to push interest rates down back down to zero again. And that causes the gold and silver miners, along with gold and silver, to just spike off that V bottom and then have a really nice run. So we don't want to miss that spike, really, and it would be nice to miss the plunge, but nobody can really time things with that kind of an accuracy. So I think the The best way to approach something like this is to just gradually buy precious metals related assets, knowing that there could be some squiggles out there and maybe even a couple of months when everything goes down hard, but also knowing that on the other end of that worst case scenario, at V bottom, is a really spectacular run when panicked governments just decide to inflate their currencies away and send precious metals, which are protection against inflating currencies, through the roof. So, what I'm doing, I'm respectful of the impact that a recession and an equities bear market could have on precious metals, but I'm still owning them and still buying really high quality assets a little at a time. With the idea that, okay, if they go down, I'll buy some more because I know what's at the other end of that V bottom, and it's going to be spectacular. Accepting that we can't know what's going to happen in the near future. I think the best way to approach precious metals in general is not just to load up the truck and buy everything right away, but to buy a little bit at a time and stay as close to possible to the highest quality assets in whatever category you're working with. Just buy good names in good places, and you're probably going to be okay.
Rubino's deep understanding of the historical relationship between gold and silver, known as the gold-silver ratio, has become a valuable tool for investors navigating the ebbs and flows of these markets. This ratio, which typically fluctuates between 30 to 80 ounces of silver per ounce of gold, offers a valuable lens through which to view the relative valuation of these two precious metals. Applying this ratio to Rubino's forecast of gold, reaching $10,000 per ounce, he suggests that silver could see prices of $300 to $500 per ounce. This projection is based on the premise that these metals often trade symbiotic, with silver historically outperforming gold when the ratio is at the lower end of its range. In the current market environment, the gold price has extended its consolidative move above the $2,500 psychological mark, remaining close to the record highs in the previous trading session. This resilience is primarily attributed to investors' growing conviction that the Federal Reserve will embark on a policy easing cycle, with the central bank expected to announce a 25 basis point rate cut in September. Meanwhile, silver prices have been trading in a tight range below the psychological resistance of $30, as investors await the release of the Federal Open Market Committee minutes from the July monetary policy meeting. These insights from the Fed's decision-makers could provide valuable clues about the central bank's future policy trajectory, which could, in turn, influence the performance of silver and its relationship with gold. Let's get back to the interview.
If you don't make me name a date, I'm happy to talk pricing because you never want to name both. Yeah. All right. So a lot of the people who have run the numbers on what it would take to back the fiat currencies of the world with gold. In other words, to go back to a gold standard where maybe 40% of the key currency that's out there is backed by gold. The price of gold that you would have to make that possible is $10,000 to $20,000 an ounce. That is not taking into account all the panic buying that might happen when everybody has lost faith in their currencies. That's just, if we decide to go to a gold standard, technically, how would we do it and at what gold price? And so you get $10,000 or $20,000 there. So I'm very comfortable saying $10,000 an ounce is something that gold is headed for. Now, gold and silver tend to trade in a relationship. It's a very wide band, but still, there's something called the gold-silver ratio, which is the number of ounces of silver that it takes to buy an ounce of gold. And that usually fluctuates between 80-ish ounces of silver per ounce of gold down to maybe 30. The higher that number is, the cheaper silver is relative to gold. And the more it's going to outperform gold, getting back to the low part of its range. $10,000 gold gets you $300 an ounce to $500 an ounce for silver. I'm comfortable with the lower end of that range. Let's say, $100 to $200 an ounce, I think is probably going to happen. $300 an ounce silver is conceivable, but it would be a place where you start to sell to the generalist money that's coming in. So $10,000 an ounce gold, $300 an ounce silver.
With gold and silver prices fluctuating in response to shifting market conditions, the question arises, will the symbiotic relationship between these two precious metals continue to provide a reliable roadmap for investors, Or will new factors emerge that challenge traditional assumptions? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.